right, well, we actually had a down day. I know we've had some other down days, but today was kind of more of a bearish down day than what we had seen in months, right? Literally months. So at least we feel more bearish than we have been, and there's actually reason for that. There's a lot of indicators that are suggesting that this is more than just a near-term decline like we've seen in the last so many months. That we bought those dips as many times as they've occurred. This one feels a little different. Doesn't mean that we might not go up on a near-term basis, but probably won't go up to a new near-term high point like we've seen. And we might be up and down, but more down for the next so many weeks. Like it appears that we're starting an intermediate decline. Again, not a big, not even a move to the 200-day moving average, which is typical of intermediate declines. But we're so far above it that would take like a 10% plus move to get down to there. Obviously, if it got down there today, it is moving. It is moving higher. But more than likely, we're going to probably stop short at this intermediate decline of reaching all the way down. So probably more in the 5, 6, 7% range, which is very typical. Very typical. We generally get one of those every year. It's really only 1 year in recent memory that we didn't get one, and that was a very abnormal year in 2017. But for more often than not, we do, and it appears that we're in the process of getting one here. And it's seasonally a time of year. We typically get them either first or second quarters. We obviously didn't get it in the first quarter. So it's the time of year for it. It's very normal. We've been so bullish, and I don't think it'll be that much more significant. But it appears like, though, again, we're probably not going to just go back up like we always do, and I'm going to show you why and what's driving today's price action in particular. Very unique pattern today, and then our trade idea, of course, at the end of the day. Stock that was in the news for its earnings announcement that had a negative reaction to that earnings announcement, and so we'll talk about how to trade that, especially in light of this new market sentiment we have. So let's go ahead and get started. Today is Friday, April the 12th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're following us on our blog here, check out some of these other things over here on the right, including our Market Outlook live video where I take a look at old trades and see whether we should stay in them or not, or get out of them. I also already put on today's trade idea before the market closed here. Come down to the bottom, click this heart. It opens up this tab, hit that like button there. Same thing here, click on this thumbs up icon. It opens up this tab, hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who like this day in and day out. Our goal is always to get to 100 likes here. Those who don't like it, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, this is, we're down more than 1% below the 30-day moving average now. So that's a considerable amount. And again, nothing significant relative to other pullbacks. It's just more considerable compared to what we've seen in all these little near-term declines. See, we've had in fact, this near-term decline still hasn't even gotten to the reversal zone. So we've had some pretty bearish short-term sentiments. You can see over here, it was pretty darn bearish. We never did get below there. Here we got down very briefly, but pretty bearish for that briefly because of very small moves, small ranges. We didn't get below the moving average. And here we are now. Now, on some of these other instances where we get below the moving average, we do have some more bearish short-term sentiment. We did form a bearish near-term peak here, so you expect that ultimately we'll get that near-term line into the reversal zone as well, or where the momentum line is, kind of follow the suit down there. Fortunately, we didn't. We came off the lows a little bit at the end of the day, so we didn't end up too extreme on the momentum line. And the near-term line still is below the intermediate line, but you notice we're not so far below that we can't, Monday bounce right back up and get right back up above that line. So obviously we had a bull tag on Thursday, a more significant one the prior Thursday, even though you don't actually see a bull tag there because we weren't light pink shading yet. We were the next day. But you can see now we have closed below both of those lows of both of those bull tags. So pretty significant change in direction there. Looking at the Dow Jones, which has been more bearish already, we are now below the 23% retracement of this intermediate run that we've been on. So if I were to kind of qualify it here so we can see, okay, here's this intermediate run that we've been on this entire time. The intermediate line has been bullish. It's now in the reversal zone. Short-term sentiments in bearish territory too and moving lower. We are well below a falling moving average. We're more than 2.5% below that moving average. We're almost in the lower decile for the past year. If I were to go out, like say the past 5 years, which of course includes COVID. Here, let's just go past 3 years. We don't include the COVID, but we do include the correction year of 2022. You notice we are not in the lowest decile. We're nowhere near that. We're only in the 33rd percent. So it's still okay from a bullish standpoint. Obviously, it's not so bearish that we're like, oh, we're going to bounce up off of this. Especially, again, considering that we are breaking that 23% Fibonacci retracement, which is generally when retracements start, right? Retracements of a certain move don't start until you break the 23% line, and then they don't end until you either get back up above it or break the 78% line, in which case now you're no longer retracing, you're just full on in a contra move there, a new trend in the other direction. So we are just starting an intermediate decline according to that kind of measurement there. Your NASDAQ 100, the intermediate line you can see has come back down. So we're back to the light pink shading. We're still above the 50th percentile barely, so it is light pink instead of dark pink. And the moving average has turned lower. So we're below a falling moving average. So instead of a light pink shading and yellow line and a new bull tag, we have a red line, right? So, but again, remember, we never did close up above that bull tag's high point yesterday. And now we're not back below the low either, which would be, kind of a bearish sign. And the near-term line itself, again, is not that bearish. It's actually still above the intermediate line. So again, this, as bad as today was, it really wasn't that bad when you look at it from this perspective. It does look like, though, kind of some beginnings of things that can get a lot worse. If you look at the Russell 2000, now down 3% below its moving average. The intermediate line's in bearish territory, below the market sentiment. The near-term line, again, is not oversold. It's not strong. It's not oversold at all, much less strongly oversold. Neither is the momentum line. But you do have dark pink shading and a red line. So we do have, again, the beginnings of an intermediate decline. Now, if I were to say, okay, so we actually did have an intermediate decline here. So let me just kind of show you. From this low point, when this intermediate run started up to this peak, you can see we got below the 23% line, barely. But we got below it. It's pretty weak. We barely got in bearish territory. So that was a very, very weak intermediate run. So if I were to say, okay, let's remove that one and draw a new one from this low point here when this intermediate run started to this high point. And you can see we are now, obviously we clearly dropped below the 23% line before we even dropped below the moving average. And then now you're looking at the 62% retracement. So we are that close to the 78% retracement level, which remember says we are no longer retracing this move, but we're actually starting a new bearish trend. So that kind of gives you an idea of just how tenuous things are on the Russell 2000. Now, the Russell did have a bearish intermediate decline where the other indexes didn't. So if I were to go all the way back out to here, where all the other indexes were, then you notice again, we are just barely breaking the 23% retracement level of that move. So that's probably more applicable. But again, it kind of goes to show just how significant this low point can be. It happens to line up on that 38% retracement level, where there can be some important technical support if we were to continue to move in that direction. All right, now let's go back to the weekly market forecast for the S&P 500. So let me throw this up here, and you can see. So at one point in time today, when we were at the lows, both these lines were below the 20th percentile. So this is a bullish intermediate confirmation signal. On a daily chart, this would be, especially lately, would be about as bullish of a signal as we can get. Very strong bullish posture, oversold momentum line, but not extreme. Near-term line that's below the 50th percentile, in bearish territory, but not oversold. I mean, this is a good bullish buy the dip signal. So if you're just looking at this chart alone, you have a good opportunity, kind of similar to this. This signal here, the near-term line wasn't below the 50th percentile, but at least it was out of bearish territory and ended up getting slightly below the 50th percentile the next week. But similar to this pattern, we're a little bit more bearish now than we were at the beginning of the year, that first week of the calendar year, but it's the same idea. So, keep in mind that we could be we could bounce off of this. In fact, last time when we kind of got a drop down in here, we did bounce up back into late 2021 before we ultimately broke down. By the time we broke down and got the bull tag, the near-term line was below the 80th percentile. So again, nowhere near a bull tag, which would be starting a correction, or a new leg higher, but nowhere near a bull tag. So we're nowhere near like a correction starting. If anything, the worst case scenario right now is getting this 5, 6, 7% pullback, right? One of these red boxes that's 5% or more, and that's it, right? That's kind of I believe is our worst case scenario. Now, the weekly chart for the market forecast for the Dow Jones is a little bit different. So you can see the daily chart's more bearish. The weekly chart does show. Now, both of these are actually below the 5th percentile. So the fact that we finished off the lows helped them not finish so oversold. But they are pretty low, and so again, that does not suggest it. Technically, is still the same intermediate confirmation signal, oversold momentum line with the near-term line in the upper reversal zone. But considering how bearish the momentum line is, considering how low the near-term line got, it's less likely to bounce back up like we've seen other instances. Again, like the beginning of the year there. So keep that in mind. Your Russell 2000. It got a bearish near-term peak, number one to begin with, and it was a divergent high point. And then now again, your near-term line's in bearish territory. You still have that intermediate confirmation signal from this weekly chart as well. So even though we do have finally a bearish candle here, which we haven't had. It's a very, very small one the first week of the year, but this is more of a bearish candle that we've had. We still are missing, on the S&P at least, the red arrow and the significant bearish candle. The Dow is a pretty significant bearish candle, so this does suggest that there is some more downside to come. But again, I wouldn't expect it to be significantly lower. Let's take a look at the 3 green arrows really quick. The S&P 500 is showing, they're all showing 3 red arrows. The Dow continues to show the 3 red arrow signal for 7 days now. You're on your 3rd straight day for the Russell. Again, most likely in an intermediate decline, but you're still on kind of now a new first day for the S&P, though the MACD is pretty significantly lower. And the NASDAQ, where the MACD is not that low, the histogram is not very significant to the downside. But regardless, you do have 3 red arrows and a red line now in the NASDAQ. These two obviously have 3 red arrows and a red line as well. When you look at the 2 lines, remember the S&P 500 did break the 30, but it has held the 50 so far. The MACD has gone below 0. The stochastics is in bearish territory. When you look at the Qs, it's also holding the 50 so far. Its MACD is slightly bearish. Excuse me. Its stochastics is not quite in bearish territory there. But again, different story on the Dow, which has clearly broken the 50. In fact, the 8 and 17-day moving averages has broken the 50. Now almost your 30 is about to cross below the 50. The MACD is clearly bearish to the downside here. The momentum is picking up still. And stochastics, including its moving average, is near the lower reversal zone. And you look at IWM, and you say, okay, something similar. We're clearly below the 50-day moving average. The 8 and 17 have crossed the 30. The MACD is clearly bearish, below 0. The stochastics is in bearish territory too. So you see how things on the Russell and the Dow are kind of showing us a little bit more bearish pattern than what we're seeing on the mega cap influenced indexes. If I take a look at some of these other oscillators, like the DMI first, again, the negative indicator still is above 25. The positive indicator dropped back below 20, so we're back to a bearish pattern there on the S&P 500. Of course, on the Dow, we are clearly trending. In fact, the ADX has jumped above 20 now. So we've almost got to the dark pink shading here. It should be at least light pink shading now. We should be able to get that. IWM, its negative indicator is above 25, and its positive is back below 20 for the first time since this little brief weak intermediate decline that we had here, where it briefly fell below 20. Its ADX is a lot lower now than it was then. So again, you can kind of see we're setting ourselves up for more of a decline than what we saw at the very beginning of the year. The RSI for the S&P is still not below 40 yet, but the CCI has dropped again below minus 150. So pretty bearish from that perspective. From the weekly basis, the CCI has not crossed below the minus 100 level, much less even below zero. So if you take a look at the Russell 2000, the Dow Jones Industrial Average, we are below zero, and we're clearly below 60. Big change in sentiment on the RSI. If you look at the daily, we have dropped below 40. So we are in bearish mode now on the Dow Jones, and we have dropped below minus 150. We're not in bearish mode. We're not out of bullish mode yet on the CCI, but we are clearly bearish mode there on the RSI. You look at the hull, the daily hull, the S&P 500, the 200-day hull is not rolled over yet, but the 20-day hull has been bearish. The MACD is not only below its moving average, but it's below zero with that 200-day, and you got some pretty significantly bearish candles, and that the average of that candle, which you can see with my cursor, is getting about to the same level as what we saw that first week in January. Of course, the Dow is a lot more bearish. Don't have a red 200-day yet, but we are way down below that 200-day hull in the lowest decile there the past year. In fact, if I were to go out the 3 years, including the correction, you're not quite. Remember the other chart we looked at this, we weren't so bearish, but this one is. We're in the 17th percentile. So that's a pretty decent move below the 200-day, which doesn't, it's not a crossover signal where you're like, oh, now we're bearish. But to get that far below it at least does suggest the opportunity to be more bearish than what we've seen, especially with the size of the candles. So things are turning south in that regard. If you take a look at the Ichimoku cloud first, you lost your trend finally on the S&P 500. So it's finally hit zero on both of these. So even if we don't get super bearish, we're not bullish anymore. The rate of change is still slightly positive, but unless we get a big jump on Monday, it's going to be negative for the first time on Monday in a long, long time. The Dow Jones, of course, is close. Is that close? You have to be at -1 and you have to be at 50. So that's how close you are to a weak trend developing on the Dow. It is below its cloud now. So again, and clearly a negative rate of change. So we are clearly in a intermediate decline on the Dow. The Russell has gone through the cloud at least. Again, negative rate of change. The green line crossing below the blue, but still no trend developed yet. So in terms of have we been so bearish this week? Now we can just bounce off of this. According to the market forecast, there's that possibility. But according to some of these other charts, it looks like we may just be starting. Again, it doesn't mean that we're going to be tanking. It doesn't mean we're going to drop 20% or even 10%. But it does mean that we might be in this up and down mode, but more down than up over the next however many weeks until we finally get to the washout move of the small pullback that we expect to have. We are in the lower quartile of the bandwidth. The bandwidth is still inside the Keltner channel. So again, you can see the bands jump out of the Keltner channels when we started an intermediate decline, and this just hasn't happened yet. We haven't had green dots yet. We haven't had any bearish momentum, but we're finally getting a little very, very weak bearish momentum right now. Again, the Dow Jones Industrial Average shows a more bearish pattern, very significant bearish momentum here, and we are pushing against that lower band. And today we did close outside of the Keltner channel for the first time for the Dow. So again, clear bearish signal there that we haven't seen, and the Russell is also pushing up down against that lower band with an increasing bandwidth there, suggesting that we're probably getting pretty close to some green dots on the Russell 2000. If I take a look at today's intraday chart, you'll see that we did not get a new 4-week low point today on the Dow, on the S&P, but that will be this will be the new 4-week low point on Monday, because this will come off, and then we'll have a new 4-week low point on Monday. And again, assuming we actually get a new 4-week low point on Monday. If we don't, like, either way, we're going to get this red line is going to jump to 100, or it's going to jump to one level below 100. So if it's a new 4-week low point on Monday, it'll be at 100. If we don't, and this ends up being the low point, then it'll be one level off of 100 there. But that's kind of like, again, we're well below the chart's midpoint. We're below the point of control over the last 4 weeks. Being below that midpoint, you can see we are in bearish territory. In fact, we're in the lower reversal zone for the first time in a while on the 4-week range. Clearly in bearish territory. We are clearly going south here. The Dow is in the lower reversal zone as well. The Russell 2000 is in the lower reversal zone. The NASDAQ 100 is not. So it's still holding up, kind of keeping us afloat from really getting a lot more bearish than what we could be, thanks to these mega cap names. As you can see, if I were to look at the mega cap names, they're still doing, like Apple was up today. After getting that bull tag yesterday, it's up today. Actually, that would be a bear tag, but same idea. I mean, it still can be a bullish signal, the beginning of a stage of a bullish move. We're down a little bit on NVIDIA, but very little compared to what we've been up the last couple of days. And we still have some dark green shading, a green line. Now, we're bearish on some of these others, AMD, Adobe, Cisco, but we're not so bearish on like Broadcom and Amazon and Google and Microsoft and even Apple. So, you know, that, and for that matter, Facebook as well, and Netflix. So they're still holding us up and keeping us afloat, helping us avoid being a lot more dramatic in this selling. Above average volume, above average range. We should be now above 1%. We are now above 1%. That's another sign that we're starting an intermediate decline. Now we're back above that 1% level. The volume is continuing to trend higher too. And then finally, looking at the VIX, the VIX is the VVIX jumped up to, it was up at 107 earlier today, finished today at 102. Again, the highest level in the VVIX than what we've seen in a while, pretty much all calendar year. But essentially going back to right over here, where in the washout low point, the VVIX got all the way up to like 115. But when the whole thing started, the whole intermediate decline started at the end of July, it eventually got up to around this level, got up to 106, 107, and that kind of started the run on volatility to the upside. We did pull back at the very, very end of the day on the VIX, but we did close above 17. We did close also above the 95% mark. So if I were to take a look at this on a daily basis, you can kind of see again that's a higher close than what we've seen in a while. In fact, a couple of closes. In fact, if you look at the 2-line version of these moving averages, we are well up above the 200-day. In fact, now the 8 and the 17-day. See, we got above the 200-day over here, but the 8 and 17-day never did. Now the 8 and 17-day averages are above the 200. So we are clearly in a new bullish volatility regime, which again is another sign. Again, and it's not too extreme either. As we know, we're not even above the 95% mark. As I showed you on this chart, we're not even above the 95% mark here. So we're not extreme. Like getting above 105 is when the washout occurs, typically on intermediate declines. Last time we didn't even get above 100% when we washed out above 20 there. But getting above 20, getting above that 200-day moving average, progressing up, getting up above 100%, at least up to 100%, if not up to 105, is very typical of volatility moves during intermediate declines, and it appears that we're moving in that direction here. All right, now let's take a look at what's driving this price action today, and you can see a big change today. Like we finally had a drop in gold prices, like the first time in a while that we've had a pretty significant drop in gold prices. So here's our day that was. Gold started off today strong. Look at that, just huge move to the upside. Bonds were up, the dollar was up, gold was up, commodities were up. It was all this kind of war trade, right? What's going on in the Middle East, geopolitical news coming out. But then after peaking, which is, again, gold's been on this parabolic run we talked about in some of our last market outlook videos. Then look at that drop. We go from being up 2.5% to finishing the day down 1%. So significant drop. The dollar didn't budge. The dollar was flat all day long today. Bonds came off their highs a little bit, but not nearly to that same extent. Commodities also came down. But equities, especially emerging markets, were down by far the most. Small cap stocks down, emerging markets down. The Qs lagged the S&P 500. So everything was down. Real estate down, but then gold finally coming down along with it. And again, you got that three-headed monster, except it wasn't yields. Yield actually went down too. So you had stocks and yields. That's not, remember, the normal relationship previous to the last few years was that yields and stocks moved in this, bond yields and stocks moved in the same direction. But because of the inflationary pressures we've seen since 2021, since that time frame, bonds and stocks have been moving in the same direction. So if I were to pull up like this correlation chart, pull up TLT here, and then change this to like a 63 day chart, or 63-day correlation. Again, generally speaking, these move in the opposite directions. That's been the normal trend. But lately, since again 2021, when inflation really started to pick up, then you had bonds and stocks moving in the same direction, so positively correlated. And then now here lately, they've been more negatively correlated, kind of returning back, and we saw that today, returning back to their more negative correlation. If I were to zoom out on this, we can see it on a little bit bigger time frame. So we'll go out to a 13-week, and then we'll jump out to a bigger time frame here on a weekly chart. Again, you can kind of see that normally it's a very negative correlation until this last little bit. And even here in coming off of the October low point, it was still pretty positive. Like bonds and stocks both rallied here until the beginning of this year. Stocks continued to go up while bonds were dropping like a rock. And now we see, you know, that correlation kind of returning back to its norm. Because we're not in the same inflationary now. Remember that they're more of a deflationary environment with falling yields, right? Yields have been falling for years and years and years until it finally hit their lowest point when you look at bond yields. Even though TNX hasn't been showing data here recently. Let's see, was it updated? No, I don't think it was updated. Let's check. No, so this is the data as of 4/5, so it hasn't been updated yet. But you can see again, TNX has been, you know, for years and years and years on this downward decline. There we are on this downward decline, downward decline, downward decline. So you have this correlation that's positive with the SPX, but as yields have been rising, it's been a negative correlation. And then now, again, are we going to start in a more of a deflationary environment where yields falter and we return back to our positive correlation and equities start to go south? You can see the stock market still trended higher even if the correlation was positive. You think, well, how can that be? Because for most of these days, you know, they're going in the same direction. They're not going in the same direction the whole time. It's cyclical. But during, you know, you had enough of this period, enough of them going in the same direction that you had a relatively positive correlation for the majority of the time there until, like I said, 2021. So that was one of the big drivers. Of course, recently, another one of the big drivers has been the move in the dollar. And the dollar really, really jumping up here today. Really having the past 3 days, if you take a look at the currency chart here, let's see here, it's actually this one, and we'll look at the currency comparison, and we'll just look at the last 3 days. You know that the dollar's made such a tremendous move. There's the dollar against the yen. It's up 1% against the yen. It's up 2% against the euro and the pound. It's up 2.5% against these commodity currencies, the yen and the Kiwi and the Aussie. I mean, these are significant. The Mexican peso and the Canadian dollar, two of its biggest trading partners, up 1.75%. So those are big numbers for currencies in this very, very short amount of time. So we've seen the move in the yen here lately has been really significant to the upside, breaking out pretty much on Wednesday. not necessarily following through with that, but the euro, big decline down below. We're below the 200-day moving average. The MACD and stochastics are down at bearish levels. If you look at the weekly version of this, you can see how significant this week has been. MACD and stochastics turning lower, moving away from the 200-week moving average, working our way back down towards parity. We were actually at parity at the end of 2022, and it appears that we're working our way back in that direction again with this significant move to the downside. You can see it here on its market forecast chart. Pull up the market forecast here. The euro US dollar. Let's look at the euro US dollar. And you can see, again, dark pink shading and a red line on the daily chart, and now dark pink shading and a red line on the weekly chart. So we're starting a new long-term bearish trend on the US dollar. The breadth was really, really poor today. You can see we had one of our biggest drops on the McClellan oscillator, down 74 points there. So a big drop to the downside. You also saw a big drop here in, let's see here, a big drop here in the number of stocks above the 50-day moving average, 200-day moving average too. But the 50-day moving average, we are well below 250. So we've broken the, just getting below 300 starts your intermediate decline. And now we're below the 50% mark. The 200-day is still way up above the 50% mark, which is, we clear that when we're in correction mode. So we're nowhere near risking a correction here. But the new highs and new lows are pretty negative, right, at minus 149. The skew is well below its average and down to 136. I mean, these are all clear signs of intermediate decline here on a breadth level. So even though, as I showed you earlier, the Mag 7 stocks did really well, it's, the breadth was just very, very poor. You can see energy having a down day today. You wouldn't expect that if we were to continue with an intermediate pullback. You wouldn't expect that to continue to be the case. Staples, real estate, and utilities all outperformed. Those are all your safety trades. They still were down, but they outperformed. And then you can see technology, communication services, discretionary, all down 1.5 to 1.75% there. All right, so for our trade idea, I wanted to take a look at JP Morgan, which came out with its earnings. You can see with a very negative reaction to its earnings, to the point where the intermediate line dropped down out of the reversal zone, below the market sentiment line already, is now almost out of bullish territory with the momentum line dropping down to extreme lows. Big drop below the moving average, 5.5%, about as below the moving average as we've seen, except some of these other instances were at their lowest point, and then we jumped off of this. Same here, lowest point, then we jumped off of this right off their clusters. Here it's at that point starting the move. So much different pattern here. In fact, we don't even have dark pink shading yet. So significant bearish move. You can see that in the weekly candle as well. And the Hakinyashi candle you can see is turning south with a large candle here, red arrow, so we're below the 10-week moving average. The PPO, which was in the above the 90th percentile, is now down. And then, of course, one of your bigger candles and what we've seen here, again, to start the move. Like you can see, like on these red arrows here, not nearly as big of a candle size. On this red arrow here, again, not nearly as big of a candle size as what we're seeing right now, especially when you also consider the range of the entire move. Kind of similar to what we saw right here, where we ended up getting some pretty decent sized candles there. If you take a look at the 3 green arrow chart, of course we have 3 red arrows with a big jump in volume today. So first time we have 3 red arrows, and we have a red line already, and you can see that jump in volume there. You also obviously broke below multiple moving averages, including the 50-day moving average. The MACD is dropped below 0. Stochastics is in the bearish territory. You obviously have bearish patterns across all these other charts. Let's take a look at the DMI first. You can see the big jump above 30, well below 20 on the DMI there. Looking at the RSI and the CCI, you can see significant bearish candles. In fact, we hadn't even been close to being below 50 for months until this move lower and then looking at like the Ichimoku cloud, you can see we had an extremely strong trend. We were above 30 on the trend quality index, and now we're done, right? We have broken that. We already have a negative rate of change. We're well below the blue line, now flirting with getting into the cloud. So significant change in sentiment. Obviously, you broke below the lower Keltner channel at least. So you didn't, but we also got below the lower band, lower Keltner channel there. Momentum is still bearish, and you're probably not going to get a red arrow because we were close to getting into the Keltner channel with the Bollinger Bands, but obviously have gone in the opposite direction here. You can see the orange line has bounced back up, the blue line has bounced back down. So we're going to be green, but we're going to be moving towards some bearish sentiment here. In fact, we're already slightly bearish at minus 30 as it is. So on this trade, what I decided to do was a long put vertical spread coming down to the May contract, coming down and selling that low 20 on the delta. Instead of buying the 170 like I would for an iron condor, I'm buying the 180 instead. It gives me right about let me get rid of there we go, about almost a 3-to-1 reward to risk ratio for the trade. Lots of flexibility for timing, so it doesn't have to work out immediately. And then again, very small reward for risk for the reward that we're trying to get for this trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up in a new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.